If you want the best ETFs for a Belgian investor, this video is the shortlist. These are the handful worth owning and why each one earns its place. But here's what nobody actually tells you. Your broker is going to show you thousands of ETFs. And once you apply the rules that matter in Belgium, you can get that list down to a lot more manageable number. So I'm Thomas, I co-founded a fintech. I also wrote a book on ETF investing in Belgium. So let's look at the shortlist. And so we put together a resource which looks at the best ETFs in Belgium. But what's interesting is that before we dig into the actual ETFs that I want to share with you, there are a few reasons why we believe fundamentally ETFs are a great investment. One, they're low cost, so they're obviously a lot cheaper than going through an active fund sold by your bank. Secondly, they run a lot on diversification, which is a big goal of index investing. So you spread across countries and sectors. So that obviously reduces risk, but also increases the chance of backing the winners. You also have a connection to the real economy. So most index funds invest in stocks or bonds, companies with actual tangible assets backing these. They're very accessible. So index investing requires very little capital to start. They are very tax efficient in Belgium, which is great. And of course, they have a proven track record, which we will actually get into. So what makes an ETF the best one? First, this is why so few make the cut. So most ETF advice online you'll find is quite generic. It ignores that Belgium has its own rules, but 4 filters almost do all the work. So the first one I'd suggest obviously is to take accumulating, not distributing funds, because accumulating funds reinvest their dividends inside the fund, while distributing ones pay them out as cash. And Belgium actually taxes those payouts at 30%. So every year you'll lose that. So you want accumulating ones, so look out for ACC in the name. Secondly, you really want the funds to be domiciled in Ireland or Luxembourg, so you can spot it from the ISIN number, so that's the fund's ID code. If it starts with an IE or an LU, you're good. Those two countries have tax treaties which currently save you money on dividends inside the fund, and most of the big ETFs are Irish, so that one's pretty easy. Thirdly, you want physically replicating funds and ETFs, and big enough ones. So physical means that the fund actually owns the shares instead of copying the index through a contract of a bank, which just adds this layer of risk that you don't actually need. So stick to the funds above 100 million euros as well, so you won't get shut down under you. And then lastly, I would say check the fund registration, check where it is, because every time you buy or sell, you have to pay a stock exchange tax called the TOB. For most ETFs, it's about 0.12%, but for a fund registered in Belgium, for example, it jumps to 1.32. So the same trade, but obviously a lot higher tax. So I'm going to show you all these ETFs, which actually have the lowest TOB as well. And so you'll see that it's actually quite easy to get the best ETF possible. If you want to own one ETF and never think about it again, you can pretty much own the whole planet in one single ETF. The fund that does this is the MSCI ACWI IMI, so we can also call it IMI. It's one ETF, more than 3,000 companies, and we're talking across 23 developed and 24 emerging countries. These are big companies, small companies, the lot. It's an accumulating fund, it's Irish, and it sits on the cheap side of the TOB. A quick disclaimer, same as always, I'm not telling you to buy it, it's just an example that best fits the one fund idea. So do your homework before. And of course, I'd love to show you how it's performed historically. So let's look at backtest. And so if we look at backtest, you can see that it's performed so well historically over time. You know, if you'd invested about 10,000 euros, you're looking at a compound annual growth rate of around 8%. And so you can see that it just follows the global economy and it does so well. You can go on to backtest, you can check out all the annual returns, the best years, the worst years. You can also check the impact of inflation, but then as well as the maximum drawdown period and then the maximum loss in a year. You can do a bunch of different analysis on there for each ETF, so don't hesitate to go to backtest to check it out. Secondly, there's also VWCE, which is one of the most popular ones. So this is a Vanguard FTSE All World. It's a brilliant fund on paper. It's got 3,700 companies, both developed and emerging, all in one ETF. Thousands of Europeans own it. But then, of course, VWCE has one big downside recently, is that the TOB has actually increased, so you'll pay a 1.32% rate with some brokers, and so that just adds a bit more complexity on it. So I think IMI can be a better option than VWCE simply just because of the TOB issue. But historically, it's performed in a very similar manner, obviously, to IMI. Let's get the other options that we have. Now, there are plenty of people watching this video probably don't even want emerging markets at all. And that's actually a defensible choice. If that's you, there's an even simpler plan. You can actually pick a plain MSCI World Fund. The one I'd point to is SWRD. So this is about 1,500 or a bit lower of the largest companies across 23 developed markets. We're talking about the US, Japan, Germany, the UK, and so on. His index has actually performed very well since 1979. And so there's been a lot of historical performance there. You might know the more famous ETF twin, which is IWDA from iShares, which follows the same index. But when you compare them together, the SWRD comes out slightly ahead, mainly because it's just a touch cheaper. I'm going to do a whole video on that, so I hope you'll follow and subscribe to the channel. The trade-off with SWRD is what it leaves out. So you don't get any emerging markets, you don't get China, India, or Brazil, and there's no smaller companies. So you're really betting on the developed world and developed markets. Now let's actually look into emerging market funds. So if you want the emerging markets back into your fund, you can actually add a second ETF. So this is EMIM, so it's the iShares Core MSCI Emerging Markets. So you get around 3,000 companies across the emerging world, from small to large, all in one ETF. And so you can put them together in the right proportion. You've basically rebuilt a VWCE yourself. So that's great. The market weight split, you can go as, about 90-10 or 89-11. That depends on you. It's my honest take, though. 2 funds means actually 2 transactions every month. There's a little bit more admin, there's a little bit more broker fees, so you have to ask yourself, is squeezing out that extra bit of diversification worth doing all your own rebalancing? For some people, yes, but for most, a single all-world fund is a good approach too. There's obviously no wrong answer, just be honest about which one you actually want to do, and you can see the historical performance since 1994 up until 2026. So all of these ETFs, you can actually find them on backtest, so you can just type in the ISIN code or type in the ETF name with backtest onto Google, then you'll land onto the tool, so you can actually play around and then do some comparisons, build a portfolio yourself, and see how it compares with other funds on the platform. So everything so far I've shown you has been 100% stocks, but if your horizon is long, it's 15-20 years, you can stomach a 30% drop without panic selling. But so you probably don't necessarily need bonds at all, but if big swings is actually going to keep you up at night, or you'll need the money sooner, bonds are there to calm the ride down. They barely grow, but they wobble far less, so they're less volatile, and they often rise when stocks actually fall. So if you add them, there's a couple of picks for government bonds. There's an X-Trackers Eurozone government bond, so it's one of the cheapest out there, 0.09% per year. And for corporate bonds as well, there's the SPDR, which I've highlighted too, which is at 0.12% per year. You get 36 countries, you get 3,200 bonds. Holding a bit of both is obviously a very sensible option. There's of course a Belgian trap here, and it can be a big one, is that if you buy a mixed fund that holds both stocks and bonds in one, if a fund holds more than 10% in bonds, Belgium's Rangers tax hits the bond part of your gain at 30% when you sell. So that's something that you should remember when you're buying it. And so there's also obviously the capital gains on taxes. I suggest that you look at the video on taxes to learn more about it. Actually, these are really interesting to take a look at if you're looking to add bonds to your portfolio. There are, of course, 2 ETFs that I've actually not mentioned, and you're probably wondering why, because they're some of the most popular. Firstly, it's the S&P 500. So it's a great index. Obviously, it's the 500 biggest American companies, and it's returned about 10% a year for decades. It's around 40% of the world's stock market. You can see its performance on backtest. It's continuously grown. And of course, the US has had a phenomenal 20 years in terms of technology and growth, but it's not a promise about the next 20 years. And so if we look also, there's also the Nasdaq 100. So that's similar to the S&P 500, except we're only looking at the 100 mostly tech actually, companies. And the past returns are actually eye-watering. They're around 17% per year since 2007. So you can see that it's just continuously gone up and up as more and more companies continue to grow and create new products and new technology. But when tech turns, there's going to be nowhere to hide. So I'm not saying they're bad funds. I'm just saying they're very concentrated bets and they're not fully diversified. And I think the whole point of index investing is to not have to guess which country or sector is going to win next. So a global fund which already holds all of these companies anyway in the right proportion. So for the core of a long-term portfolio, I take the boring whole world fund, which neither of these US focused funds actually have. So there was your shortlist. Obviously, if you want the one-line summary, it's one global accumulating Irish domiciled ETF is a good start for most people. And then, of course, you can add the IMI. It's a very cheap way to own it in Belgium through a broker. The one question that always kicks off, though, is a big one. Is it developed world fund or is it full or world of emerging markets? Is it IWDA versus VWCE? That's obviously something that continues to debate online with different investors. I'll settle it in an upcoming video, and I'll also do a bit more on taxes. I'll see you there. Obviously, none of this is personal advice. This is what I've learned, so you can make your own call. Thanks for watching.